Well, good morning, everybody. I'm delighted to be here to moderate this panel on the role that lenders will play in helping the economy recover from the pandemic. We've assembled a great panel. We have two regulated banks, very different regulated banks. We have one alternative lender from Sweden, and we have a government-backed lender. So, hoping for a few different perspectives from that panel. In time-honored tradition, let's start with some introductions. Emily, if you could kick us off, please.
Sure, sorry, I'm unmuting my mic. Hi, I'm Emily Hogg. I'm Head of Lending and Investment Operations at Innovate UK. Innovate UK is the government's innovation agency, and they've been doing loans and investor partnerships since 2018. So we are looking to support those businesses that are completing R&D projects, later stage R&D projects, who are suitable for debt finance. We're not trying to compete with any mainstream banks, and we're not trying to take any of those customers away. We're trying to fill what they call the valley of death, where SMEs have used their personal savings to start up their business, but they're not yet suitable for debt finance. They may not have produced any revenue, and they're just looking to do something innovative and different, and that's the businesses that we support.
Excellent, thanks. Conrad.
Hi everyone, I'm Conrad Ford. I'm the Chief Product Officer of Alaka Bank. Alaka Bank is a bank in the UK, a new bank in the UK focused on the SME segment. So our target customers are established SMEs, not the micro businesses that are being targeted by lots of digital players, but the established SMEs that represent about a quarter of the UK economy. My background is actually Fintech and then previously banking. So I previously founded a business called Funding Options, which is Europe's leading aggregator website for SME lending. I founded that business 5+ years ago, and it now operates in the UK and also the Netherlands, having received investment from ING Bank. And then before that, I was in banking in the run-up to the global financial crisis. Thank you.
Excellent, thanks. Alexis, over to you, please.
Yeah, hi. So my name is Alexis Kopylov. I'm the CEO and founder of DBT, which is a Swedish SME lender fintech. Just as Conrad, we focus, and Alaga Bank, we focus on the established SMEs. Our customers are often family-led, more established companies, not the micro companies, looking for long-term financing to establish and grow the companies.
Thanks, Alexis. And finally, Matt.
Hi everyone, I'm Matt Nyong. I'm a Vice President in Silicon Valley Bank's Fintech warehousing team. So we provide warehouse financing in the form of asset-backed securitization style structures to SME lenders across EMEA. As you can imagine, prior background is mostly in structured finance, both from the lending side and the origination side.
Excellent, thanks Matt. Well, last and definitely least, I'm Brendan Gilmore from BPS Strategy. I'm a consultant with about 25 years experience in financial services inside and outside banks. And I try and help market participants to demystify the landscape, given how complex it is. I try to make quality introductions, and I try and help people to successfully engage with each other, because I don't always come from the same perspective, the traditional and the fintech players. But onto the question, we talk about the role that lenders play in economic revival in the title of this panel. So I just wanted to get people's perspective on what that economic revival looks like. And the context for that is we've seen, unprecedented levels of government support for the UK economy, not so much in Sweden. And we've seen the structure of the economy change, some potentially irreparably. So I just want to get people's perspective on what economic revival looks like for you. And maybe if I could start with you, Conrad, to get that, please.
Yeah, thanks. So I'd start off by saying that it's very easy to think that in terms of SME lending, we're in the middle of the storm at the moment. And certainly in the UK, I would say that that's not the case, although people seem to think it is. We have had extraordinary levels of government intervention in the SME lending market. And I think that's papering over a lot of cracks, and probably papering over cracks is a massive understatement. I think papering over massive chasms. What has happened in the last year or so is that government has backed something like 1.5 million loans to businesses. So loans to something like a third of the SME population. There are wildly varying estimates around how many of those loans will default. but some reliable estimates say sort of 30-40% of them. So very large numbers of government-backed loans are expected to default because they've gone to businesses that unfortunately may not recover. But most importantly, that government lending has kind of propped up the incumbent or the alternative lending segment. So there are there's many documented examples of where businesses have replaced alternative lending with government lending because the rates are cheaper, there's less commitments, there's no personal guarantees. But effectively, that's acted effectively as a nationalisation of the alternative lending segment. When the government lending begins to dry up, and at some point it has to, the only question is when, then effectively the papering over the cracks will go away. And my personal view is that we will see an SME financing gap that's certainly unprecedented in my lifetime. There is usually, of course, an SME financing gap in the following a recession. But I think this one, unfortunately, will be a different scale. And the reasons for that is because the major high street banks, of which there are 4 or 5 in the UK, rather than being the villains of this crisis, have actually been the heroes. And this enormous kind of Dunkirk-like exercise of getting an enormous number of loans out to businesses at an unprecedented scale and speed, they've really been the linchpin of that. And it will take them a long while to unpick the operational complexities of actually collecting out of those loans, which they're required to do. So I think operationally, the big banks will be actually distracted for a number of years as they unpick the consequences of the fairly heroic role they've played. We have to be clear about that. In terms of the alternative lending segments, they've had, in many cases, defaults that would have happened on their portfolios as a result of the recession we're in have not happened because the money has been refinanced with government debt. But the real question is whether those alternative lenders can continue to lend post-COVID. In other words, will the wholesale funding be there for institutions that don't have a bank license? And I think in many cases, the answer is probably no. We just haven't realized it yet. So my view is that we haven't really seen yet the impact of COVID on SME lending. And unfortunately, here in the UK, I think it's going to be of fairly staggering proportions, the impact on the SME lending segment. And the much vaunted SME finance gap that we've talked about for many decades, I think unfortunately is going to be at a different scale to something that we've seen in quite a long while.
Excellent. Lots of kind of big points in there to come back on. But Alexis, I'd like to get a perspective from you on Sweden, given Sweden has taken a very different approach to COVID, or at least that's how it's reported here. So it would be helpful to get your perspective on the ground. And then just your take on that point about what economic revival is going to look like.
Yeah, thanks. And as you mentioned, a lot of interesting points. And I think we've all heard about the Swedish experiment. And I think we'll take quite a lot of time before we know if that was a successful experiment or not. But I think coming into that, I think there are several differences between the Swedish market and the UK market that sort of needs to be mentioned. One, just to put sort of on the macro platform and understanding, the SME challenger lending market is much more immature than it is in Sweden than it would be in the UK. So it's still a market dominated by sort of the high street lenders. So we haven't seen that growth of alternative lenders in Sweden, as you would say, in the UK. So just coming back to that later on. But I think what's been really interesting with the Swedish experiment are actually two main events. So one being that the limited lockdown, in the sense that businesses were still up and running. I remember that I looked at the Google mobility report in March, looking at sort of the retail movements in Italy were down 95%. They were down 85% in the UK. But only down 40% in Sweden. So we're still some movements. You didn't see that massive, although a massive drop, but not sort of the really, really tough drop in revenues. You still had restaurants ongoing, etc. So in that sense, businesses were hit, but not to the same extent. The second part that's really different is the amount of government relief. So the National Debt Office put in place quite a lot of programs, but it's still a limited amount of money of those that have been deployed. I think in August, it was reported there was less than 600 companies that actually had received loans, and that's 2.5 billion SEK, around the 250 million sterling. So still a fairly small amount that really had been pushed out to the SMEs, and that was driven by main factors. For one thing that Conrad mentioned is that the high street banks sort of took the responsibility of working with their customers. Secondly, the program only included sort of the banks, which meant that it took a different approach than it did in the UK, as I understand it, where all of the alternative lenders were enrolled in different government programs with the C-bills and B-bills, with just a small deployment stuff. So I think, although we are sort of awaiting for sort of the third wave, in the sense that SMEs that are still on life support, I think that issue is not as relevant in Sweden, although there still have been some support in tax relief, etc. But they've still been forced to manage quite a lot on their own. So we're not awaiting that massive sort of cover-up relief as you would expect in the UK.
Okay, yeah, that is interesting, and I think you're right. It'll probably be 10 years before we know who took the right approach. Matt, just get your perspective on things, please.
Yeah, absolutely. And I think there's a couple of really interesting points there from both Conrad and Alexis. I think probably the one that I'll touch on first, specifically from Conrad, is about the government support and, you know, the artificial support that's given and performance that's given to the UK economy and SMEs. I think, you know, following on that more, you could probably look at as well the insolvency rates over the past 12 months being the lowest they have been in the last 10 to 20 years. Obviously, one of the main drivers of that is the UK insolvency bill, which has been passed earlier this year at the beginning of the pandemic, and I think that has, you know, led to slightly maybe misleading data in performance of SMEs in the UK. I think now that that's gone away, and over the next 6 to 12 months, it will be interesting to see how that plays in conjunction with the removal of C-bills, B-bills, CR bills. So that's going to be a very interesting interaction between the two of those. That may also lead to, you know, us seeing some real spikes in delinquencies and defaults and insolvencies in the next 6 months. And, you know, I won't say a perfect storm for the two working together, but that's definitely something to keep an eye out on in the next in 2021. I think also, just kind of moving further from that and touching on Alexis's point, there are definitely different nuances across Europe, and that is a direct correlation between what we've seen from governments and their government support. So, you know, if you look at Scandinavia and the Nordics as a whole, and other areas of Europe, particularly Germany, where there has been government support, but not to the extent of the UK. There's also been a kind of proportionality or a correlation between government intervention with the pandemic itself. And really what you've seen is taps being turned off and turned on a lot quicker in the rest of Europe and the Nordics. So something which then is also a product of how quickly we can recover in the next 6 to 12 months. I think we're probably going to be looking at something a lot slower in the UK compared to what we're seeing in Denmark, the rest of the Nordics and Germany. So lots of interesting things to take from there.
Yeah, thank you. I mean, it does feel like we haven't figured our way out of it yet here in the UK. We're going to have to, you know, the clamour is to keep the life support there for longer and longer and extend out repayment terms. So I don't think we've felt the economic impact yet. Emily, have you anything to add to that?
Yeah, so I guess the question around economic recovery and the government intervention bit, I think there will be things that the government has to do and has to change, because when they put these measures in place, who was to know that the pandemic would last this long, and whether those measures actually now are still relevant. But there still needs to be that support for SMEs, because if the government support does fall away, then those SMEs are going to be then looking back at their banks and saying, you supported me before, and I still need your support. I still need you to carry on supporting me. And if those banks can't do that, or they won't do that, then the government does need to intervene. Otherwise, as the guys have said, there will be, you know, the cracks will start to show, and those SMEs will start to fall over. In terms of the revival, I agree with the guys and Matthew that it will be a lot slower, I think, than the rest of Europe, and what people are hoping, that we would have that sort of quick bounce back. Doesn't feel like the UK has been managed in a similar way that will allow us to do that. And I think that the pandemic has been a lot more exacerbated here than perhaps it has been elsewhere because of the slower intervention and the fact that we were trying to bring the economy back and we haven't quite managed to strike that balance. So we should be looking at a longer term recovery and the ways that we can look to support those as well. And that's something, I guess, that there will have to be innovation and change, not only from government but from lenders across the board, and how they look to deliver to those businesses that need their support.
Great, thank you. Well, against that backdrop, and it struck me in sort of thinking about today's panel, in normal times there has to be a good balance between prudent lenders and quality borrowers, and we don't have either really, because borrowers tend to want to borrow to thrive, but at the moment they're looking to borrow to survive. While lenders typically want borrowers who are going to be sustainable, and they can't really guarantee that at the moment. So I'm just wondering what that ecosystem will look like going forward, given there almost needs to be a truce for this to work for the next few years until we figure our way out of this. But I just wanted to get your perspectives on that equilibrium between lenders and borrowers, and whether both how they'll both evolve. So Alexis, maybe if you can start on that, please.
Yeah, and I think that's an interesting point, because I believe we'll see a polarization between different segments. So you actually have quite a lot of segments that have thrived during this period, a lot of trends that have been accelerated that have made sort of the business model even more profitable and enable them to grow. So you will still have that sort of access to capital. But I agree with you in sort of the unbalance of lenders who want to grow and deploy, whereas you still want to manage the quality. So I think over time we'll definitely see the becoming focus on the quality book growth, and that's mainly sort of course, to the high street banks, but also to all challengers coming to sort of get their proof of concept versus investors, etc. But I think also what I want to point out, sort of the difference in business models also from a lender perspective that we will see. So in my opinion, there are actually two major trends that have affected due to the COVID. So one is linked to the digital experience of the lending, but also the second being part of the human, the relational sort of experience and part of the business model. So for one, in terms of digital experience, never have we seen so fast the erosion of the competitive advantage of a retail branch network. So all of those who had a competitive edge of being locally anchored with a retail branch network have seen that edge disappear overnight, where all of those that can meet their customers in a more digital way have thrived. And coming back to Conrad's sort of example of the microfinance companies mainly supported through an app, of course they have grown as usual, but the more sort of established SMEs that still require the human element have turned towards lenders who can meet them in these types of forums with digital data rooms, meeting rooms, etc. And coming back to my second point on the relation experience, is definitely in the way we would trust underwriting. I think we will come back to really the craftsmanship of credit underwriting, where we will see SME challengers that will refocus on really actually, or at least in our segment, more established SMEs that will refocus on having or enabling the bespoke and tailored underwriting that is leveraging the human expertise and the know-how, where sort of all of these words as data, that will only be supportive. So we will be more data supported and tech supported rather than just defined by tech.
Matt, given you focus on lending to lenders, I'm really interested in your perspective on this.
Yeah, I think as for understatement of the year, the past 12 months has probably been quite educational for us all, on the lending side and the borrowing side. We've all probably had to earn our corn with restructures, amendments, restatements, and waivers from borrowers having arrangements to pay and forbearance. Compared to consumer sides, obviously SMEs have been greatly affected by this. If you look at the rate of arrangements and forbearance measures in SMEs, they are much higher than, say, consumer lending. I think with that, obviously, there's been a real focus on underwriting, and Alexis did touch on this. These are the times where you use your data as an asset in your portfolio management, but then also this really does for me bring the focus of it's using data and your machine learning as a supplement instead of your number one piece of sustenance. The companies that we've seen ride out this the past year really well have been companies who have used both of this. So in your portfolio analytics, using data as an asset to be able to see key pockets of your portfolio which perform well and perform not so well, and using that real time, day in, day out, month in, month out, and with different nuances to both seasonality and, of course, what's going on with the pandemic. On the underwriting side, you can't get away from the fact that you need the personal touch, as Alexis mentioned. I think the idea of completely automated underwriting sounds great. It's probably a bit more applicable on the consumer side, although I don't necessarily think that a completely automated process on the consumer side is what we will see. But on the SME side, there is no escaping the fact that you will need to have some level of human touch here. Where automation is going to be key is obviously more on the onboarding, KYC element to, and also, avoiding elements like fraud, disputes, and such on the SME side. I think there's probably going to be a stage as well where we have this transition. And the transition is SME lenders going away from providing, especially, and this is especially for the UK, C bills, B bills, whatever kind of government support it is, and that propping up their portfolio balance and outstanding balances, to going back to their classical products and the need to expand on those. Some of these products that SME lenders provide may be essentially very different, and have previously provided may be essentially quite different to those provided in C bills and B bills. So there will be that transition, and I think on the bank side, who are funding SME lenders, this is where we'll probably see our need, especially in the mid to latter part of this year, to provide that funding gap. I mean, Conrad did touch on this, that there is clearly going to be a small funding gap when government support goes away, and I think that's where banks come into play to be able to fill this.
Great, thank you, Matt. I'm just wondering, Emily, does your role change as a result of this sort of imbalance between lenders and borrowers that potentially may materialise on the basis that you'll have to step in, you may be given more funding by the government to do more lending that traditional lenders wouldn't do? What's your take on it?
Yeah, I think there'll be a role for Innovate UK, but there will also be a role for the British Business Bank, and it's just whoever the right lender is for that. We will still look at innovation. We're still looking at high growth companies. The British Business Bank are more about supporting established businesses and established SMEs. And I think just quickly picking up on one of Matt's points about transitioning to their classical products, I don't think SME lenders can transition back to what they had before. I think the market and the landscape is going to look so different for those SMEs that actually going back to what you did before and saying, I want historic financials, I want security, I want personal guarantees, I just don't think that's going to work for some of the SMEs as they come out of this. British Business Bank research has actually showed that over 70% of SMEs will rather not borrow any more money and forego growth because they're so, averse to this structured and very overbearing type of borrowing that typically traditional banks offer. So there is going to have to be a shift between those borrowers. Otherwise, we're going to see more and more SMEs become less willing to take on that form of borrowing as banks and lenders become more prudent and actually want more security, because they may well have been burnt by bounce back loans or the level of fraud that people are seeing in those applications. That's going to make banks take a step back And if SMEs are also then taking a step back and saying, no, I want something different, I want something more supportive, then the chasm just widens even further. And then there is the role for government to say, if we want growth, we need to support banks and SMEs to meet somewhere in the middle. And yes, there's a role for Innovate UK in there to look at the niche section that we're looking at of, the very high risk, the very innovative businesses. And there is a huge role for the British Business Bank, but there also needs to be a collaboration between the British Business Bank and those huge, bulge bracket banks to support those lenders. Otherwise, there's the chasm and no one to support those SMEs. But ultimately, I think if that does happen, that level of SME kind of market in the middle, someone will step in and say, actually, do you know what? I will take that space. I will create something different. I don't think over time there won't be someone who will step in and say, actually, there's opportunity here. So it's whether those banks want to flex and change to support that is the question, rather than government support always being there, because someone will step in and take that opportunity. It's just a matter of time.
Yeah, and I think that was part of the premise of my question, is that in order to continue, they have to change their own motivations from a profit perspective, because I'm not sure the same level of risk or probability of default or expected loss that drove models before now can actually continue to drive them if they want to continue in their previous role. Conrad, I'm on the basis that Allica is in hyper growth mode at the moment. I imagine you've looked at where the borrowers that you're going after are, and you've probably segmented the market. Like, what are you seeing?
Yeah, so Alaka was very fortunate in its timing in that we had recently got a bank license and just started lending as COVID hit. When that first lockdown took us all by surprise, which meant that we had capacity to lend without a reliance on wholesale funding. And at the same time, we had no back book to worry about. We had no forbearance issues to worry about. So as a result, actually, we chose not to do government lending schemes. And one of the interesting dynamics, which is probably not talked about enough, is there's like somewhere between 25% and a third of businesses, this is the best trading conditions they've ever known. It's obvious who they are, right? It's e-commerce businesses, logistics businesses, it's healthcare businesses. So there's a thriving segment of SMEs, albeit for the worst possible reasons. And actually, they are largely speaking being neglected in the current market. Whole swathes of the lending community either can't lend or are exclusively doing government lending schemes, which by definition, you have to be suffering from COVID to access. So our focus has been on those growth segments. I mean, in terms of a few observations about where we are now and where I think the market will be. And there's been some excellent contributions on this point, by the way. I agree with pretty much everything I've heard. So firstly, I've made the observation before that the small ticket lending to micro businesses has effectively been nationalised by the government. And one of the consequences of that is that we will have hundreds of thousands or perhaps 1 million plus businesses that have so much debt on their balance sheets of government lending that they will not be able to sustain more debt. In other words, unfortunately, they will be kind of not in a position to invest to grow post-COVID. And many businesses, of course, even worse, unfortunately, will not make it through COVID at all. In other words, they will default on their government lending. The positive of that, of course, is that businesses will grow into those gaps. Okay. And one of the interesting features of the global financial crisis was how few businesses actually went insolvent. In other words, we didn't see much creative destruction. We saw hundreds of thousands of zombie businesses that somehow managed to make it through, even though they had too much debt. I think this time is going to be different. So what do we expect to see? We expect to see growth finance, particularly focused on medium-sized businesses. So businesses that are actually beginning to take advantage of the market share gaps that will emerge post-COVID. To think the business that's operated for 10 years in one town and then decides, as its competitor in the next town has actually gone under, it decides to actually expand or to acquire them or to acquire their premises. So we see growth financing, and there is a kind of positive potential spin-off there that may actually begin to engage with the UK's productivity issues as we begin to see ambitious businesses beginning to take steps they perhaps wouldn't have taken in a more competed market. So that's kind of element number one. I think the other one which has been touched on here is that historic credit models won't work anymore. Okay. So the incumbent advantage you have of being an incumbent pre-COVID, the enormous reams of data and experience and corporate knowledge you have kind of disappears. So let's give a real example there. So I live in Winchester, which is a town you commute to from London if you have to. We're a good hour away. And pre-COVID, we had to, right? That was the done thing. So 4 or 5 days a week, people like me would be going into London and spending our money in London's restaurants and London's coffee shops. Well, actually, post-COVID, we'll be going into London 1 or 2 days a week. I guarantee it, yeah? And you know what? We're going to be spending our money in Winchester's cafes and restaurants, right, at lunchtime. So this kind of thematic thing of this is the death of the high street is one thing I hear. It's much more nuanced than that, yeah? And historic credit models will not allow you to actually figure that out. So, when I think about this, I think you need to avoid the phenomenon of trying to catch a falling knife. In other words, when the markets are in free fall in some shape or form, don't try and jump in then. But the businesses that are well run, that are on the front foot, the lenders on the front foot will actually have enormous opportunities coming out of this because a lot of the data disadvantages they had against incumbents disappeared overnight as a result of COVID. So I think there's some really interesting dynamics, but again, I kind of think we're all going to be figuring it out over the next 6 to 12 months. And really it's about the lenders that are in the best possible way opportunistic. So in other words, that they sense the time's actually the right time to make a move. They have the balance sheet, they have the resources to actually make a move. It's going to be a very attractive environment for those lenders.
Okay, interesting. I want to come back on a point you made in the opening, Conrad. You talked about the fact that alternative lenders, you don't think that they'll get the wholesale funding they need, if I understood you correctly. Why? Can you just build on that a little bit? And then I'd love to hear what Alexis's perspective is, given he's reliant on sort of institutional funding to run his business.
Yeah, so what normally happens in a downturn or a credit crisis is that wholesale funding disappears for lenders, yeah? And that was, the global financial crisis was a textbook example of that. So to give one real example that really brings it to life. So we have a challenger bank here in the UK that was founded at the very depths of the global financial crisis. So one of the big private equity firms knew that the time was to have a new challenger bank, and they went out and hunted down a bank license. They found a sleepy bank, they bought it, they rebranded it, and they grew it. But the interesting thing is the heritage of the leadership team that ran that business, which is now a big success. The leadership team in question had been running a lender in the same segment, the same category, but they had not been a bank. They'd been reliant on wholesale funding. And actually their lending was very good. They were very capable, they were very competent. When the wholesale funding markets panic, they do not discriminate, they just panic, okay? So what hasn't happened this time round, because of the unprecedented, I know is a word we all use, is unprecedented level of government intervention, is that we haven't seen that collapse in wholesale market confidence. But the question for me is effectively in a world where you are not sure which lenders really did well through COVID, because all of them were propped up by government lending, and the credit models that they would have taken into a discussion with you pre-COVID, have zero validity, then it becomes much more challenging to actually pick the lenders that you actually want to give wholesale capital to. And your loss rates on that wholesale capital have to be really low to make it work. So now this is not a end of the world story. What it is effectively is that I think wholesale funders will be much more discriminatory. They'll be looking for traditional credit skills. They'll be looking for some of the stuff that Lexi was talking about brilliantly before, which is effectively, it's not just about the data, it's also about the expertise, the knowledge, the credit underwriting capabilities of the people behind the business. Have they been there? Have they done it? Have they been through the cycle? These are the things that will matter. So it's not about the end of everything, but it's hard to believe we'll see the same level of support for alternative finance post-COVID than we saw before.
Okay, I'm going to come back on it, but I just want to get Alexis's take on that too, if you wouldn't mind, Alexis, please.
Yeah, no, definitely. I think that's really interesting thoughts, and I think all lenders at the end of the game want to sort of have diversified funding, not to be sort of dependent on any source. I think as you grow, that's definitely part of the strategy. But I agree with you. The wholesale funding could work very well in uptime, but could also be very challenging. From our perspective, just as you mentioned, we are funded by institutional funding, so totally dependent on wholesale funding. What we saw was actually, and it all comes back to timing. You mentioned timing, Conrad, in terms of where Allica was. For us, it was a bit the same. We had been through the peaks and had received sort of several rounds of institutional funding. We're also part of sort of a program with the European Investment Fund. So we're part of the guarantee program there, which sort of also give some relief to the wholesale funders. So what I think we will see is definitely increased barriers of entry for new players, those who doesn't have any track record, who haven't shown. So from our perspective, we see it as a relatively positive thing that wholesale funding is dried up, because we see the difficulty. It wasn't easy before, and it was it's always a struggle to get the track record and sort of the trust of getting that amount of money. But I definitely see it would be much more difficult. Wholesale funding will be reluctant to deploy in SME lending, and will actually, as you pointed out in the beginning, would want to wait out, not saying, okay, where will this actually play out, the SMEs, where will we see the default rates? So we'll see little to none activity in that sector versus SMEs for the coming 6 to 12 months. So those who sort of have secured funding, either being through deposits or already have sort of a secure funding line on the wholesale sector, will definitely be able to grow away from sort of potential new entrants.
Okay. I think, I feel you can say with almost 100% certainty that nobody really knows what's going to happen. And just against that backdrop, a lot of wholesale funding is provided by the big banks now, where that might not have been the case very historically. But after the last crash, the only route to the SME market was through wholesale funding. They were letting other SME lenders do it. So I do wonder whether they will try and find a way to continue, because they've no other access to that market, because they've almost lost touch with SMEs. But Matt, given you're a relatively new team embarked on lending to lenders in this space, what's your take?
Yeah, it's an interesting one. I would say that it's going to be a very interesting time in the next 6 months. I think with the alternative lenders that you have in the SME space, you're going to need a few things. Obviously the track record is going to be a big thing. Strength of your management team is going to be key. I think having a well-capitalized business is something that's going to be very, very important. I think sometimes the skin in the game that's required is something which is, maybe underestimated, and having that well-capitalized, strong investor backing for an alternative SME lender is going to be key. And then also just being able to having the speed to pivot your portfolio. One of the things that I mentioned before, and the rest of the panel have mentioned, is this inflection point between government funding and that being removed. A lot of these businesses who were looking at exponential growth and looking at institutional funding of 100 million plus a year, 2 years ago, have had their portfolio of their classic product in runoff for the past year, 2 years, which means there is that funding gap now of you're looking at something in the 50 million space, under 100 million. And a lot of the big institutional lenders, quite frankly, won't get out of bed for that. So really there's an opportunity there for previously established businesses who are coming to the end of their funding, who will need a new element of funding from an institutional lender. There's also that space for the growing SME lenders. Conrad, you've mentioned, some of the fast pivoting businesses who have, taken the opportunity to pivot their businesses or, take advantage of differences in consumer behavior and SME behavior. I think that's where the opportunities are. And I think that's where institutional lenders should be taking their focus. And that's definitely where we will be focusing as well.
Yeah, thank you. Thanks, Matt. Emily, I guess it doesn't apply quite as directly because you rely on government funding to fund your lending. But like, what's your take on the availability of that going forward? Because obviously the government has taken out a very big bazooka to try and solve this, and at some point they're going to have to stop or ask the taxpayer for more. But what's the feeling within Innovate UK?
Yeah, good question. So obviously we got a swell of funding to support COVID, and that's the government borrowed, I think, more than it's ever borrowed before, and that's not sustainable. So there has to be some outcome from the borrowing and the investment that they've put in. So they've not just put in lending. Obviously, they've done all the stuff through British Business Bank, but there was 750 million that went into Innovate, and that was through grants and loans. So supporting businesses with grants that obviously they don't have to pay back. So it's the government are looking for the return on that investment, not just the loans that we're getting. We don't have any certainty into the next financial year into what our programs look like. We have a small window of certainty, and then there are more government announcements that we're waiting on to see what that support package will look like. But I imagine that there's a whole scale thing that they need to put in place. But at the moment, we are still working through COVID recovery, and that's our focus at the moment. And I don't think we can kind of look too far beyond that at the moment. There's still so much work to be done there.
Excellent. We're slowly sort of moving towards the end of time here, but just one other thing I wanted to touch on is that, in normal times, lenders have to worry about borrowers and repaying, and that's true now as it ever was, but with C-bills and B-bills in place, I just wonder the level of debt that some of the lenders have pushed out there, and they're completely reliant on the government guarantee to pay out when the time comes. And I see some of the stuff during the week. The FCA talked about guidance for how payments are collected and how people have to comply with the Lending Standards Board's guidance. I just wonder, did a lot of the lenders who are new to this from pushing C-bills and B-bills out, are they aware of what the collection cycle will look like and how that will impact if they don't get the money, and when they go cap in hand to the government to pay out on the guarantee, will that have any implications? Conrad, have you any thoughts on that?
That's putting me on the spot, isn't it?
Just a bit.
Yeah. I guess, for the big banks, they have the ability to absorb almost anything. I'll caveat with the almost, but almost anything. For the challenger lenders that have poured into government lending schemes, the question that they have to be asking themselves is basically, to what extent is the small print going to matter? Yeah. So the difference between the verbal commitments and the high level commitments you get in terms of government support versus the small print on which the government can potentially, let's say, create grey areas in terms of where the guarantee actually stands. I think it's going to become, I would imagine it's going to become a big question over the coming years. And I think we'll see a growing amount of noise about it, because in the end, it's going to be challenging for the government to be involved with so many what will ultimately, unfortunately, be businesses being pushed into insolvency. It's going to be politically challenging. The timing of when that happens will be getting closer and closer to the next stage of the election cycle. I'm, of course, talking about the UK here. So I personally think we have a lot of noise ahead of us around the government guarantees. And suddenly, there will be a point in time at which the small print really, really matters.
Yeah, and that's what struck me. Anybody else, any perspectives on that? Alexis, maybe?
No, I think sort of that it's always a political game in the end, as you mentioned, the big banks or high street banks being able to absorb, whereas the challenge is a bit too small. But at the same time, politicians need sort of to maintain and uphold the trustworthiness of the programs they put out in terms versus the sort of the investment community. So one way trying to push back where there have been sort of operational risks or inefficiencies at the challenger lenders, but I would think they will weigh that versus sort of having a too hard pushback, which means that no one will trust the next program put in place. Hopefully not in the near term, but further down the line.
Yeah, no, look, I think the difficulty is that the level of support that was needed with such urgency in such great quantities. There are going to be unintended consequences, and I think it's just important that people are aware of those. Any final thoughts from you, Emily, on what we've talked about?
I guess the government support is, there's a lot of saying, it's government lending, it's government backed lending, and those lenders should have, is where they could responsibly lend that money with the government support in place. I think, there will be a lot of unravelling of that, as some lenders will have taken it a bit further than they perhaps should have done, and seeing that quick opportunity. So it's going to be a very interesting couple of years as that unfolds, for sure.
Excellent. That leaves you, Matt, with the final word for this panel today.
Yeah, I think the main point is just going to be the fact that the government support lending and products were probably not necessarily intended for the world we're in. Probably not assuming that we were going to have 3 lockdowns within 12 months, and there's going to be a bit of a cleanup after that as a result.
Okay. Well, look, can I just say thank you to Conrad, Alexis, Emily, and Matt for those insightful thoughts today, and thank you to everybody for watching. I hope you enjoy the rest of the conference.